Hey, welcome back. It's Jason Walter here. In today's housing market update, I have a lot to share with you, including an update regarding pending home sales in the US. This is a leading indicator of what to expect with our housing market in the next 1 to 2 months. In addition, I have an update for you regarding mortgage interest rates because those have been increasing greatly lately, as of last week actually. So let's go ahead and dive into today's video because I have a lot to share with you and I'm really excited to do that. The best way to show you all this information today is to share my screen. So let me do that with you right now. And by the way, my voice is all messed up because last week I lost my voice. I haven't made a video in a week because I just regained my ability to talk. So in any case, this is a pending home sale index thanks to the National Association of Realtors. They just posted this a couple of days ago, or a few days ago, September 29th to be exact. So let's go ahead and dive in here. So contract signings rose 8% in August from July after 2 consecutive months of declines. So as I reported in my previous past 2 videos, or past 2 months of videos here, the pending home sale index decreased in the last 2 months, but more recently it increased by 8%. So we're going to talk about why this is. I'm going to be diving into a lot of this data here. In addition, contract signings rose in all regions from 1 month ago, led by the Midwest and the South. In contrast, though, contract signings, which again are pending home sales, were 8.3% lower this time compared to last year. So that's a no-brainer because the housing market was absolutely on steroids last year. But I have some data to share with you regarding how this compares to 2019 and 2018, which are more normal real estate markets. So again, this is as of September 29th, and this is for August pending home sales. All right, so pending home sale index, or their PHSI, is a forward-looking indicator of home sales based on contract signings. Contract signings means when a home seller accepts an offer from a home buyer, right? That's a pending home sale. So they talk about rising inventory and moderating price conditions are bringing buyers back to the market, according to Lawrence Yun, who's NAR's chief economist. He also said affordability, however, remains challenging as home price gains are roughly 3 times wage growth. I talk about this in a lot of my videos where I feel that housing affordability is getting worse and worse because home prices are increasing greatly, but not at the same rate that wage growth is. So I'm going to be sharing some stats with you regarding rising inventory and moderating price conditions here in just a little bit. Such an imbalance in the market, meaning an imbalance of affordability, is unsustainable over the long term, according to Yun. I 100% agree with him on that. You can't have home prices increase 20% every single year and not have wage growth increase at the same rate. All right, so let me give you a breakdown on a regional level here. So let me share actually an infographic here. It's best to share this with you here. So again, the index increased 8% compared from July to August of this year. But each region varied pretty greatly though. So on a month-to-month basis, the Midwest increased the most by 10.4% and the West increased by 7.2%. In addition, the South increased by 8.6%. Northeast only increased by 4.6%. So about half the rate in the South, for example. The other thing I want to show you too is how the pending home sale index has changed over time. I think it's really important to take a look at that rather than just looking at how's this compared to 1 year ago and also how's this compared to 1 month ago, right? So when you're looking at over the last year for this pending home sale index, we're at 119.5 as of August, right? So this is the highest reading since January of this year, right? So the index has kind of been all over the place this year, but we're still at higher level compared to February, all the way through February, right? In last year, the index was just very, very high because we had such high housing demand last year. So that's that. I want to show you how this compares to prior years though, right? So again, here's January 2021 right here, and that's 123. So in August, increased to 119. When you compare that to, I believe these are averages, so 2018 through 2020, I believe these are averages for the pending home sale index. So if that's the case, then in 2008, the average was 105. In 2019, it also was about 105. So compared to now, or any really reading over the past year, we're way higher compared to 2019 or 2018. I know you guys always ask, how's this all compared to those years? Because comparing to 2020 is like comparing apples to oranges, right? The housing market was on fire. But Let's go back to Yoon's statement here that we have rising inventory and moderating price conditions that's bringing back home buyers to the market, because after all, the contract signings rose 8% from July to August of this year, right? So let's first talk about rising inventory. I talk about this a lot on my channel. So Fred has a lot of good economic data. They just basically pull stats from different websites, or different sources, I should say. So this is housing inventory, and this is over the past year. And the source of this, whenever I share these Fred graphs, the source is always at the bottom, by the way. So this is according to the National Association of Realtors. So when we look at housing inventory compared to 1 year ago, in August 2020, we had a 1.5 million. Now we're down to 1.3 million approximately. We have increasing housing inventory so far this year. So right in January of this year, about 1 million. In February as well, but ever since February or ever since March, housing inventory has been increasing greatly. So it did decrease in August, but not by very much. It was 1.3 million houses available for sale, and these are existing houses for sale. And then in August, it was 1.3. So a difference of only 20,000 of a decrease. But when you compare this to January, let's say, 1 million, now it's 1.3 million. That's a 30% increase of housing inventory. What that means for home buyers is that there's more options available, right? If you have 30% more houses available for sale in the US, as a home buyer, you have more options. That's really what we need. We actually need this number to increase quite a bit more than this, but it's a step in the right direction. In regards to home prices, as I mentioned in my previous video from about a week ago, home prices have been decreasing for 2 straight months in the United States for the median home price, median sold price. And that was not mentioned in NAR's report, right? I didn't mention that in my video though. In any case, we're looking at the median sales price of existing houses in the US. It was at $303,000 in January 2021. And they've been increasing greatly every single month except for the past 2 months. So one thing I want to point out is that, home prices reached all-time record highs of $362,800 in June of 2021, right? I did mention that home prices have decreased for 2 straight months, but look at the price decreases. They didn't fall off a cliff. It's $363,000 basically in June, and then now we're at $356,000. What's that, a difference of $6,000? So it's not a big decrease, but it is a step in the right direction if you're a home buyer looking for prices to decrease. We'll have to see if this trend continues. Another thing that a lot of you guys point out is that even though home prices decreased for 2 straight months, we're still at very elevated levels, right? So $356,700 in August, compare that to January of this year, I think that's about almost a 20% increase in just 8 months. So prices have increased greatly. So that's the one I want to talk about for pending home sales. Leave me a comment if you guys have any questions regarding that. I'm talking very quickly because I've had a lot of coffee today. In any case, I want to go over mortgage application numbers and then also mortgage interest rates, because there's a lot in the news right now that's really affecting mortgage rates, and then thus decreasing or causing a negative effect on mortgage applications. And by the way, I'm thinking about making a video about my real estate market predictions for the rest of the year into 2022. So leave me a comment below if you want me to make a video regarding that. I might make a video regarding that this week if I have enough time to research and kind of think about what I really feel what's going to happen in the housing market. But if you guys have an interest in that, leave me a comment below. And also hit the like button too if you guys are getting any value out of this video. All right, so let's talk about the mortgage applications. So this is according to the Mortgage Bankers Association, or the MBA. I always talk about their housing stats they release on their website. Really good resource. So they just released this about a week ago, last week, and they stated that the seasonally adjusted purchase index decreased 1% from 1 week earlier. What this basically means is that from 1 week ago, they have an index for purchases and also refinances. So this overall market composite index composed of purchase applications for loans and also refinance applications for loans. So it decreased by 1% from 1 week ago, big deal, right? But it was 12% lower from the same week, 1 week earlier. In any case, Joel Kahn, who is the MBA's Associate Vice President of Economic and Industry Forecasting, he stated the following. I thought it was a really good quote here because I'm going to kind of dive into this about why mortgage applications may be decreasing, and more importantly, why are mortgage interest rates increasing greatly as well. Increased optimism about the strength of the economy push treasury yields higher following last week's FOMC meeting. That's the Federal Reserve's meeting. Mortgage rates in response rose across all loan types, with a benchmark 30-year fixed rate reaching its highest level since July of 2021. The increase in rates, mostly later in the week, led to a decrease in both purchase and refinance applications. So this is going to be really interesting to track this, because if interest rates continue to go up, one would assume that's going to decrease the demand for housing. So I'll have to make a video about that with my housing market predictions though. All right, so let's go over this, because they say that treasury yields have been going up, and they absolutely have. So I want to show you how they have been affected by this meeting, or the Fed announcing that they're going to be tapering their purchases of mortgage-backed securities, and potentially may do a interest rate increase towards the tail end of next year. So this is the 10-year US Treasury note, which is tied very loosely to mortgage interest rates. So when the yield on the 10-year US Treasury note increases, mortgage interest rates could increase as well. And then in contrast, when it decreases, rates could decrease as well. But it's not tied directly, it's indirectly, loosely tied to it. So in any case, the US Treasury note, as you can see here, this is year to date. When you look at this, in January this year, we were under 1% for the US Treasury yield, right? It increased to almost 2%. I think it was like 1.75%. was like the highest it's reached so far this year, and that was in late March. And then it would decrease quite a bit, and this is when mortgage interest rates dipped as well. But more recently, it's been increasing, especially when you look at a 1 month trend, for example. Take a look at that. 1.3 last week on the 22nd of September. Now it's been increasing quite a bit, right? So 1.3, now we're at 1.5%. So have a look at this. The date of when the Fed announced that they're going to be tapering their mortgage-backed security purchases and may increase federal funds rate, when they announced they may increase the federal funds rate potentially late next year, that was in September 21st to September 22nd. That was around that time period. And so have a look at what happened around then, right? So when they announced it, it was around 1.3. And when they announced it, that's when the US Treasury yield absolutely skyrocketed. So it's going to be interesting to see how this is going to affect mortgage interest rates. But when you have a look at the mortgage interest rates, let's just have a look at them over the past 1 month. So the 21st, 22nd mortgage interest rates, according to the Mortgage News Daily, was around 3% for the average 30-year fixed rate mortgage, right? But ever since the Fed made that announcement, the rates have absolutely skyrocketed, right? So we're at 3%, they increased to almost 3.2% in about a week. They have been decreasing more recently. We'll have to see if this trend continues though, because it's gonna be very interesting to see how this will affect our housing market if it increases greatly. One thing I did want to point out though is that the mortgage interest rates have been all over the place. They tend to change and fluctuate every single day, right? So they decrease to the lowest levels this year, about 2.75 in late January of this year. But interest rates increased to almost 3.5%. But what happened to home prices during this time period in March of this year? Home prices still increased to record levels. So an increase of almost 0.75%. From 2.75 to 3.5, it didn't have an effect on housing demand. It didn't appear to have an effect on housing demand. So I would assume that we'd have to have a pretty large increase in order for it to negatively impact our housing market. I'm not a fortune teller though, so we'll have to see what happens here. I want to share a quote here to kind of wrap this video up here. We're about 15 minutes. Mortgage rates jumped above 3%. This is according to Freddie Mac. They announced this last week. But they had a good quote here from Sam Cater, who's Freddie Mac's chief economist. He said, mortgage rates rose across all loan types this week as the 10-year US Treasury yield reached its highest point since June. Many factors led to this increase, including the Federal Reserve communicating that it will taper its support of the capital markets, the broadening of inflation and emergency energy supply shortages, which compound other labor and material shortages. So again, they're talking about the support of capital markets. That's the purchases of mortgage-backed securities and other bonds. He also says that we expect mortgage rates to continue to rise modestly, which will likely have an impact on home prices, causing them to moderate slightly after increasing over last year. What do you guys think about all of this? I'd love to know your thoughts about this, so please leave me a comment below. But I hope you got a lot of value out of this video. If you did, please hit the like button. I greatly appreciate that, and hope you have an awesome day.